What's up, guys? Welcome back to another trading video. Today's video we're going to be going over like what I would do. It's more of like a beginner's guide. What I would do if I were to start out as a beginner day trader. So yeah, basically we're going to go in step by step and what I recommend doing at first, and then I recommend when it comes to technical analysis and how to trade and how to take setups and this and that. So anyways, so before the video starts, I want to just shout out my own Discord server that I just made. It's a small community. There's no one really in it. It's just a few people. But if you guys want to start up a community with me, then go ahead. Feel free to join. I'm using the link in description. You can see it says like Discord link. You can click it and then start joining. It's not as optimized yet. I'm gonna start adding more things in it, but I just want to make my own trading community, and I think it would be cool to get to know more of my viewers and have a solid community around our trades, and so we can take trades together and stuff like that. So yeah, anyways, let's get right on to the video. Alright, so basically what I would do from the beginning is download this app on your computer or phone. It's called TradingView. Now most of you know what it is. The ones who don't know what it is, download it because you can actually use it to chart out your charts. You can use it to draw on it, freaking put shapes on it if you want, you know what I mean? You can it's a tool app that allows you to take your setup so you can enter on another app. And there are other apps, there are multiple other apps you can trade on. You can even trade on TradingView, but that you need a broker for that, and I don't recommend a broker for anyone who's doesn't have a high income, or at least like a high amount of money to trade with. So I would recommend a prop firm, which is short for propriety firm. A prop firm gives you equity based on how much you spend. So it gives you like an account. Let's say you buy an account for $400 and it has $50,000 in it. That is called a prop firm account. So it's funded with some capital, which allows you to play in a playing field along with some rulings, and you have some rules to follow so that you can then gain some money through it. Right, so brokers essentially allow you to. The reason why I don't like brokers is because they kind of B book you and A book you. It's really complicated. If you guys want to go check a different video out on someone else's video after this video, seeing what A booking and B booking is in brokers, then you guys would understand. Anyways, I'm getting off track here. Let's actually set in the stuff that you need for trading. So starting out, I would, number one, open up a demo account. So a demo account is a fake simulated account. It's called paper trading. How you do that is you go to this app, TradingView, you click on trading panel, right? And you scroll down and click on paper trading. It says brokerage simulator by TradingView. So when you click it, you can actually click connect and then start trading fake money essentially, and just practice as if you're actually trading with real capital. And then after that, once I would basically do that for around 6 months to a year, and that's what exactly I did. I did it for 8 months. I paper traded for 8 months, and then I got used to the markets. And then I kind of bounced back and forth between crypto futures and forex. But now that the US banned forex trading on a specific app called MetaTrader, and all prop firms have been failing with forex, it's kind of not the space I like to be in. I'm trading futures, so I'm a futures and index fund trader. I don't trade crypto futures and I don't trade forex anymore, right? I do follow along with crypto stuff. Like I have some stuff invested in crypto, obviously, but that's not the main priority of this video. So yeah, anyways, what I would do is I'd trade my demo account for around 6 months to a year, and then after that I would start looking at buying a prop firm account. So you have to make sure you're profitable in your demo account, then you can buy a prop firm account, because obviously you don't want to just blow your money over something that you don't know what you're doing in, you know what I mean? So once you get your prop firm account, this is what I would do. So I would this is called risk management, right? My management. Yeah. 2%. So I would risk 2% of my account. My space button is not working, it's acting up. So I would risk 2% of my account, meaning if I have $10,000, I'm only risking $200, which is nothing, obviously. But when you buy a prop firm account, this is the beauty of buying a prop firm account, right? Because if you have like $50,000 or let's say $100,000 account, you can risk $2,000 of that account, and because every account is leveraged by 100, that 2,000 is essentially 200,000. You know what I mean? So you can put in 2 lots, which is, if you guys have like an app called MetaTrader or an app called TradeLocker or Daytrading or whatever app you guys use, every app has lot sizes. So if you have $100,000 of capital and you risk 2% of the account, you put only 2 lots out of 100K. Okay, so you put 2 lots out of $100,000. That's risk. That's managing your risk. And if you have $50,000, you risk again 2%, but that doesn't mean you put 2 lots. You put 1 lot. Okay. If you have a 25K account, you put 0.5 lots, etc., etc. You know what I mean? So what I would do, what I actually did in the beginning is I would I would trade with 2%, and when I'd win, I would actually keep trading 2%, not in the same day, obviously like different days. Like once I win, I would close my chart and go the next day. Then I would trade again, and then I would trade 2% until I lose. And when I lose, I would trade with 1%. So I actually drop down 1% on loss. Then when you drop down 1% on loss, you keep trading 1% until you win. So let's say I'm trading 2% and I lose. My next trading day, I'm going to put in 1%. Okay. Then if I win, I'm going to put back 2% again. So every time I win, I put back 2%. Every time I lose, I drop down 1%. All right. It's that simple. That's how you manage your risk, and that's how you make sure you don't blow your account, and that's how you make sure that you're all good to go. All right. Third thing, like third category, I guess, aside from risk management, is learning how to actually trade the charts. So now we got the risk management down. It's super simple. It's not that hard. And it comes down to psychology as well. When you lose, don't revenge trade. Make sure you do not revenge trade. Everyone made the same mistake. I made the same mistake. Every one of your favorite traders that you guys watch made the same mistake. And even the millionaires that are up now, they've all made the same mistake, obviously. So try not to do the same mistake. Don't revenge trade. If you take a loss, take it like a man or woman, and let it go. Go on the next day. It's not that deep. All right. Don't dwell on it. Don't dwell on it. All right. So third category would actually be, the strategy aspect. So once you get that side down, like understanding how to manage risk, you can't manage risk without understanding how to trade. So I kind of went backwards, but you need to know that risk management is the main priority. Then it's the technical analysis aspect, because that aspect is easy, right? You can make up your own goddamn trade and it'll work. You can make up your own shit, and you know what I mean? It'll work. So there's a few thousand, if not even more, strategies out there when it comes to day trading. My favorite pair or thing to trade is the NASDAQ 100, because it's the most volatile chart in the market. All right. And it gives me great returns. I instantly, once I put my order down, there's money moves quick. You know what I mean? So there's 3 things not 3 things, around, I guess 5 things. 5 basic things you have to know when it comes to technical analysis. So the first thing we need to learn is liquidity. So liquidity is simple way to put it. It's like a rubber band. I wish I had a rubber band with me. It's like a rubber band, and imagine pulling it down and letting go. So you're pulling the rubber band down boom, you let go. And when you let go, there's a trail left of where that rubber band has been stretched to. You know what I mean? Then you pull it up and you let it go. There's a trail that got left behind that shows where that rubber band has been stretched to the upside, right? Now, anywhere between that, anywhere that price moves between those stretched areas, that is where liquidity is being played in. Okay, so those two zones are called liquidity: buy side liquidity, sell side liquidity. Same thing happened in this example I'm going to show you. So we're going to grab our line tool on TradingView, left side. We're going to mark out the top side here because this is called liquidity. Remember what I said? Imagine it as a rubber band. Stretch up, boom. You know what I mean? Boom, right back down. That is liquidity because the market pulled back down. Now, sell side liquidity is this down here because price was playing. Boom, it stretched back. It stretched up. The market went on a bull run, kind of like a bullish momentum, whatever you guys want to call it. Then anywhere between this field here and here is all playing with liquidity. Now, how do we use that to our advantage? I'll show you guys in a bit. So, can we actually edit through this? We can't. That's weird. Okay. Next, we need to learn what market structure shifts, liquidity sweeps. Okay. That's our next thing. So liquidity sweeps are a raid in liquidity. That doesn't help you guys, obviously, but there's so many names to it. There's a raid of liquidity, liquidity sweep, A plus raid. That's pretty much it. I guess those three are the main ones. I like to say raid of liquidity or liquidity sweep, whatever it is. Liquidity sweep means when price makes a higher point than the previous liquidity. In this case, up here, price did not make a higher point. It actually made a double top. I don't trade patterns, but this is a double top. So it made the same level or relatively the same level. Okay, it's called a relative equal high. But price down here swept liquidity. You know why? Because this point down here was lower than the previous sell side liquidity. So the rubber band got stretched, made a mark here. Next time it actually got stretched again, but the market stretched it further than the previous liquidity. So the liquidity came from here to down here. Okay, so that's basically what happened here. That doesn't mean every time liquidity sweeps happen, it happens on the downside. It can happen on the upside, but it's just whatever happens first. Okay, whatever gets swept first is the liquidity sweep. All right. Now, before moving forward, there's a lot of things to actually, go over with. Like, there's so many beginner things. I've made so many videos, countless videos about how to read a chart and how to understand time frames and time zones and all that. I'm not going to get into it in this video because it's too much. It's really too much content. You guys have to go back and watch my previous videos because I actually go in depth and show you guys how to navigate TradingView and how to understand time zones and time frames and sentiments and this and that. And if you guys don't know what bullish and bearish means, honestly, go learn that. Again, I teach it in my other videos. Go learn that before you continue this video, because you guys need to have some sort of slight basic understanding of trading to then understand what I'm saying. Because right now, if you guys don't understand it, it's all gibberish to you. All right. So liquidity sweeps. We just covered that. Right now we're gonna cover what we said earlier: market structure shift. Let me type it down. Market structure. I'm typing slanted, so it's maybe typing a little bit slower. So market structure shift is basically a shift in the trend or market. So we know what trends are. Trends are a continuation of variations of lower lows and lower highs, or higher highs and higher lows. In this case, in this example, let me delete these lines so I don't confuse you guys. In this example, I drew a line down showing that we are on a downtrend slope, right? We're on a downtrend. every time there's a trend, we're gonna try to look for an opposing trend, like an opposing, basically a market structure shift, a shift in the market, so that it can reverse up, back upwards, or back downwards, whatever it is. This current example, we're going downwards, so we're gonna look for an uptrend in a second. And how do we identify that? We identify that through market structure shifts. Now, market structure shifts happen in multiple different variations. There's different forms of it. There's countless of them. You just have to know which one you're playing with, okay? So, I'm going to draw it out for you guys instead of showing you on the chart first, then I'll show you on the chart after. So, let's say we're going on a downtrend, making lower low, lower high, lower low, lower high, lower low. Now, a market structure shift would look like something like this. Price would come up, right? It would retrace, make a lower high. A lower low, and lower low, lower high. Yeah, a lower high. Then price would stop its momentum of creating lower lows. So you see how previously these other lows down here were creating more lows, like lower than the previous low? When the market slows down its momentum in the trend, that's when you anticipate a market structure shift. So it stopped creating lower lows. Price is slowly reversing to the upside. It's slowly gaining traction back up. It's like when you stop at a red light, you're going 60 miles per hour, you stop at a red light, and then you're slowly going back up again, you know what I mean? Or you're reversing out of your driveway, and then you start going, you know what I mean? It's the same way. You're switching momentum. So price is going up and actually creates a higher high now because it broke above the lower high that was previously made. Okay? So lower low, lower high, lower low, lower high, lower low, lower high, higher low, then higher high. So price actually broke above the previous lower high, meaning that is called a market structure shift. Now the actual body of the candle has to close above that market structure shift, or that lower high, for it to count as a market structure shift. A wick doesn't count. And if you guys don't know how to read candles, again, I can't stress this enough. Go back to my other videos and watch how to read candlesticks, because I don't need people being super basic. Like you need to know an understanding of trading. Okay, so the candle body has to actually close above the previous lower high. Okay, so what does that mean? Price will then continue making more higher highs and higher lows and being on an uptrend. We're now going on an uptrend. That's the trend now. Okay, so let's delete this, and I'm going to show you guys an example on the on the chart. I keep voice cracking. On the chart. All right. Now, in this scenario, price was making lower lows and lower highs. Where do we get our market structure shift? We don't get it. We don't get it yet. All right. Price just made a huge leg up without making a market structure shift. Then this would be our market structure shift point, right? Price came back down, made a lower low. So it made a lower low than this previous low over here. Okay. So I guess that is what's called liquidity. Okay. You can also call that liquidity. Price made a liquidity, a rate of liquidity. Then it shot back up and broke structure of this market structure that it made over here, this higher or this lower high, because this high is higher than this and this high is lower than this high. So these highs are all going lower and lower. So this is our recent lower high that was made. Okay, so after the liquidity sweep, we got a market structure shift. Every time we have a liquidity sweep, we always look for a market structure shift. The reason why price didn't continue going upwards, so I'll explain that in a second. This candle, you see how this candle body closed above, this blue one right here that I'm talking about, closed above that line, meaning that candle made a market structure shift. A wick is the line that happens above a candle. If it just wicked up, it does not count. It doesn't count at all. That's not a market structure shift at all. Okay, it's just to have a confirmation that price is strongly going up. What happened after that? Price retraced back down, filled orders into the zone, and went back up. You could make money based off of just this move up. It's just a straight move up. Okay, and we're on the 5-minute time frame, so that's a pretty decent amount of, that's a decent trade. That's a decent trade to take. But the reason why price didn't continue going up higher and higher is because we were at a closing session. This is, as you can see the time down there, we're at this market closed at 4:55 p.m. and then it continued over 6 p.m. And we know that Asian session, which Asian time, that the market is slow and consolidates during that time. So if I'm going to give you guys a better example of how a market structure shift is, but this is one of these fewer examples of how it could look like if everything goes wrong, I guess. Okay, so essentially you want to take your profits if you are trading before 5 p.m. Eastern Standard Time. Then I wouldn't, honestly, I don't recommend it if you're trading right before 5 p.m., which is closing time of the market. But if you are, I would be cautious doing my trades because the market won't follow your confluence and it won't follow what you have essentially advantage of over. Okay, so I'm going to show you guys another example because this doesn't always happen. This doesn't only happen with downtrends; it happens with uptrends as well. So let me go show you guys that real quick. These are my previous trades. Ignore them. So here is a good example over here. So you see how price was making uptrends, right? It's making up, higher high, higher low, higher high, higher low. Ooh, price failed to create a higher high. Right? This right here did not create a higher high above this high over here. Okay? That means we're going to now look for a market structure shift. Price made a market structure point early on, and then what happened? Price sliced through that market structure shift and actually closed this black candle, which is my bearish candle, closed below this line. You see this candle right here, this black one, closed below this line, making it a market structure shift. Now price, that tells us the price is reversing direction. Okay, it's starting to go down, 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 down. Okay. But just because a market structure shift happens, it doesn't always mean that it's going to continue going down forever. There always has to be a stop at a certain point and then a reversal again and again and again and again. It's always a continuation of the same repetitive things over and over every single goddamn day. And that's how you trade. Every day is a repetitive thing, and it shows, the data shows every day you can take the same trade over and over and over. It just looks different every single time, but it's the same thing. Okay, it might look slightly different, but it's the same thing. Now, what are we going to look for next? Our third, or was it fourth? Our fourth thing is a fair value gap. Okay, so a fair value gap is a gap in a candle that has no opposing orders. We know that there are buy orders and sell orders, which is called long orders and short orders because we're trading options, right? The lower the time frame you go, the more fair value gaps show up, and that's what gets confusing to a lot of people, and especially the students that I teach. A lot of them get confused, okay, at first. So a fair value gap is only valid when you pair it up with your strategy. When you get a liquidity sweep, when you get a market structure shift, and then when you get a fair value gap, that's when you identify it properly, and that's when you can trade off of it properly. You can trade based off of fair value gaps solely based off of it alone, but it's not going to work in your favor most of the time. You're going to have a really low win rate, and you're going to start losing a lot of your trades because there's not enough confirmation for you to enter. There's no advantage for you, right? Because there's so many of it, it's too common. You have to identify the right one that works for you. So let's say we get a market structure shift. We just spoke about what it means. So this price over here got shifted by this candle, correct? obviously. We were going on an uptrend, price stopped making more highs, lost momentum, came down, boom, boom, shifted below this low, and this low, and this low, and the other lows previously, right? But obviously we look at the most recent low, so this low got broken, and this low got broken by this black candle, and then a fair value gap consists of 3 candles, okay? We're going to grab our rectangle tool on the side, and we're going to mark out our candles. This is where it gets tricky for everyone. So I'm going to zoom in a little closer for everyone. Let me zoom in closer. So you guys see these 3 candles, right? 1, 2, 3. The candle that created the market structure shift, this one right here, it's a really long candle, and that's called an imbalance, okay? It's called a volume imbalance. This candle had zero, almost zero. Well, when we say zero, it means a couple thousand, maybe less, a couple hundred buy orders, okay? It had a little bit of opposing orders in it, not much. The orders beforehand, same thing, not many opposing orders, because if there were opposing orders, price would make high wicks everywhere. It would wick around, okay? So you grab a rectangle tool, you make sure you mark out the bottom, and this is for bearish fair value gaps. I'm going to show you guys bullish in a second. For bearish fair value gaps, you're going to mark out the bottom of the first candle, right? Then you mark out, you skip the middle candle, and you mark out the top of the third candle, including the wick. Okay, so as you can see, this top of this wick got marked out, and the top and the bottom of this first wick got marked out. And then you're going to drag the rectangle tool out, and that's your fair value gap. So this candle, this volume imbalance that we spoke about recently, is the fair value gap. So anywhere in that zone is your entry point. You're going to enter for a short once price gets into that zone, so that you can take your short trades. All right. Your stop loss, you put it above the fair value gap. All right. And if your fair value gap and stuff was closer to liquidity and your entry was closer, you put your stop loss above liquidity. Okay. Not right above it, a few pips or ticks above it, so you can have space for your stop loss to not get hit. You need to put it above, slightly over your fair value gap or liquidity sweep. Again, it is confusing. And if you guys are still confused even after this video, you guys can DM me on Discord, Instagram. You guys can click my WAP link in the description and sign up for my mentorship. I have a private group mentorship. I have a one-on-one live mentorship, so I teach you live one-on-one on camera. And I have a course where you guys can, it's all pre-recorded. You guys can go ahead and learn. It's a really, really long course, but it really helps you guys. It would definitely help you guys learn everything about trading, and I'm still uploading stuff into it, so there's always new content being uploaded. It's not just pre-recorded and that's it. There's always things being added into it. It's like your own little YouTube video or own little YouTube channel you guys can go ahead and watch that teaches you everything step by step. So here is a great example of a fair value gap, and our entry point was perfect. Obviously you guys wouldn't really know where your take profit would be. That's where I would go to a higher time frame and see where to mark out my zone or my take profit. Obviously there wasn't any good take profit zones. What I would do is go a little bit back and see, like, mark out this zone down here, and then go down to the 5 minute. But once I go down to the 5 minute, as you can see, price actually didn't end up tapping it until later on. So it's kind of, you need to make your own take profit point. I can't really show you guys the take profit point because it's different for everyone. For me personally, this would be enough. This trade would be enough for me, and I would take my profits out. You know why? Not because of the candles, not because of how the chart looks, but because I know that income, the money that I would make just from that small move, would be so much. It would just be enough. Like, it'd be so much money. It'd be enough. And obviously we're trading for money. We're not trading to have fun. We're trading for money. So I'm being 100% blunt. This is enough money to make in the trading or in the market. This is definitely enough. This would give you a couple thousand, maybe even more. Depends on your lot size again. But let's say we're putting in 2% and we trade this. We're definitely making around $2,000, maybe a bit more. So this is a really big move, and it's great. It's a 1 to 2 risk to reward, so you guys can do your little own calculation through that. All right, so that's what I would do. On my fourth confluence, I guess. A confluence means just a confirmation of your strategy. So the fifth thing we're going to go ahead and cover is not more so of a strategy-based thing. It's more of an understanding of the market. So we need to understand how investors work. Okay. So the fifth thing, that's why I said there's this 4 and there's also 5. You need to understand how investors work. Okay. So put yourself in an investor's shoes. Would you guys buy? Let's go, and to best understand this, you guys need to go on a higher time frame. You need to, like, you actually must, like, you cannot do this in a 5-minute time frame. It will not work at all. So you guys must go on a 1 hour or 1 hour plus time frame. That's what I love doing, and seeing where we're at right now. We're at a huge decline. We're at 19,500. That's where price is right now. Price all-time high was, let's go on the daily, 20,794. That's where the highest price in the whole entire world of NASDAQ was, right? So what do we do from here? Put yourself in the investor's shoes. Because we got a huge retracement, let me find where's the price? Is it this one? Okay. We had a 6% decrease from the top of this wick. As you can see, the top of this candle, we had a 6.16% decrease of the market. And as an investor, right, obviously I'm going to act like I'm an investor even though I'm not. And the investors in the banks and institutions would love to buy at the bottom. That's why that's why there's a saying that obviously you newbies think that, oh, you have to buy low, sell high, which is not true completely. It's somewhat true, right? So in this case, you would buy low, you'd sell high. In this case, the investors sold high. And how do you know when your high point is? You got to analyze the data, and you kind of use common sense. We're at a huge uptrend. Nasdaq is an index fund, so it's always going to be bullish. So is the S&P 500. It's always going to be bullish. I'm voice cracking 24/7, but I don't give a fuck. We're always going to be bullish, right? But there's going to be some setbacks and some pullbacks into the market, because that's when investors and banks are taking their profits. And when someone takes a profit, when someone removes, let's say you invest in a piggy bank, and that piggy bank has $1,000. You put in 500, and then that piggy bank will grow 10% per year. You take your 10% off with your 500, then the initial value of the piggy bank will go down, right? Because you're the biggest investor basically. That 1,000, you're investing 50% of what that piggy bank is worth, right? So you're the biggest investor in that piggy bank's market. When you take your profit and your share, that piggy bank will be worth a little less now. It's gonna pull back, and people can actually buy lower at a lower price because it's worth less. In this case, it's the same thing. So you have to look at. You have to react to the market. Don't follow the market. React to the market and then follow. So don't sit here and be like, oh, I'm gonna buy because why not? No. Over here you shouldn't buy. Over here you shouldn't sell until you know why. So when the price gives you a market structure shift like this on the hourly, you're going to mark out, and obviously I'm too far for you guys. You're going to then start using their confluences even on the hourly. It works. 100% works. You put your fair value gap. You mark it out. You get a tap into your zone, and then if you would just sell, because there was a market structure shift, if you would just sell your position right where it taps, you would 110% make so much money on this downtrend that it happened right there. And this happens every single time. It's a guarantee. It literally is a guarantee. This is the only thing that's guaranteed in the market. When you actually understand the back end of how everything works, everything is guaranteed. Everything. Every single goddamn thing is guaranteed. You can never have a market structure shift like this and then have price move and push up further. It's impossible. It's literally impossible. That's not how it works. Everyone would lose money, including the banks, investors, institutions, whatever it is. Okay? So, what now? We're down here. What do? We're going to react to what happens next. We're not going to sit there and start buying at the bottom, because price can still make lower lows technically. Okay, so we're going to wait for a market structure shift at the top here, then a fair value gap, then the top of the fair value gap, and start entering at the lower time frames. You can go down at 5 minute, 15, 30, whatever makes you guys comfortable, even the 1 minute. But it's all subjective to everyone. But knowledge is not knowledge. Logic is not subjective. Logic is always, it's a fact, right? So you have to know your fact before putting in your opinion in every single thing in this life. And that's how life works, right? In this world, that's how life works. You have to know the fact, then input your opinion. Everyone who trades their own strategies, that's their opinion, right? ICT, that's his opinion on how he likes to trade. Me, OCT, that's how I like to trade in certain ways. I teach a different strategy than what everyone else teaches, because that's my opinion and that's what works for me. And that's what people would like copying, because obviously beginners, I copied ICT at first, you know what I mean? And that's what makes the market that's what makes the market, you know what I mean? But yeah, that's what I would do. These 5 things, go ahead and practice these every single day on your demo account. This is what you need. These 5 things are what you need on your demo account every single day. And this is what I stress on and teach in on my courses and my mentorship and my private groups. This is what I do, right? And I just I've never had anyone lose. I've spoken about this on my TikTok. I've spoken about this on YouTube and Instagram and wherever. Okay, I do the same thing. This strategy never dies. Okay, this strategy never dies. So this is what I would do as a beginner. I would learn these 5 things because they're very important. And once you learn these 5 things, then you can have different strategies play in. You can have premium and discount zones. You can go in more more advanced and start learning your your kill zones, and you can learn your equilibrium, and you can learn all these stuff. But right now, don't overwhelm yourself. And as a beginner, I overwhelmed myself too much, to where that's how I lost over $20,000 in the first year of day trading, and that's what I'm trying to prevent you guys from doing. So you guys need to really understand how to be patient, especially in the market. You need to be really, really patient. Practice a lot until you're ready. And that's all the advice I can give you for now in this video, because this video is pretty long, I can't lie. But that's basically it. I hope you guys enjoyed this video. Thank you guys for watching and being patient throughout this video, because this is a pretty hefty long video and I've been yapping a lot. I'm going to try my best to stop yapping as much in my videos. But anyways, thank you guys so much for watching. I hope you guys enjoyed and learned something new. And yeah, peace out.